makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, today live from the JPMorgan Global Markets Conference here in Paris. Now, here's what's coming up on today's program. Global stocks rally with the S&P 500 hitting another record high as cooler U.S. inflation reinforces bets on Fed rate cuts. While Slovakia's Prime Minister is in a serious condition after being shot in an assassination attempt, the first European leader in more than 2 decades. Plus, Xi Jinping tells Vladimir Putin that China-Russia ties should last a generation as the Russian leader receives the red carpet treatment in Beijing. So, as corporate leaders and, of course, investors gather here in Paris for JPMorgan's Global Market Conference, we'll have some pretty big interviews on the economy and, of course, on politics. The highlight, 1:15 p.m. London time, where I'll be speaking to the bank's chief executive, Jamie Dimon. Now, let's also take a look at the European markets map. Now, yesterday was pretty extraordinary. We had data from the U.S., and we saw a rally. Actually, stocks at a record high. European stocks today, you can see the European markets map really hovering near record highs again after that U.S. inflation data reinforcing bets that the Fed will start cutting interest rates this year. Now, there's much more improved risk appetites or improved appetite for risk assets. And that, of course, because of the CPI figure, easing maybe some concerns that inflation was entrenched. So we have a lot of market commentary saying that's maybe a little bit premature, but today watch out for a raft also of European central bank policymakers due to speak. Traders almost fully pricing in the likelihood of 3 cuts for the year kicking off next month for the ECB. Now, to talk about markets, to talk about the Fed, inflation, and everything in between, I'm delighted to be joined by Richard Tang, the global head of markets at Rokos Capital, for an exclusive conversation. Richard, so good to speak to you, and in Paris, and the day after CPI numbers from the U.S. Is the market just too optimistic about actually what the Fed does next?
I think so. I think there is an assumption in the market that you can extrapolate this data, and we've seen this happen many times in the past, where you have an extrapolation of the data, and only to see that really change significantly over the coming months. And I think if you look at this data, it was more benign, but at the same time, if you look at 3-month trailing or 6-month trailing core CPI, you're still at 4%, 4.1% on 6-month trailing. So I wouldn't say that we're close to the Fed's target of 2% yet.
So, Richard, I mean, is it odd that the central bank is not trying to actually keep market expectations a little bit lower, because that feeds into financial conditions as well?
I do think that it's odd, but I think we are in a different era today. After the last 20 years, central banks have become very addicted to giving forward guidance to markets, and at the same time, markets are very addicted to getting forward guidance. So everybody wants to hear what the Fed intends to do with policy. I think the problem that you end up with is that forecasting has become very, very treacherous. I think if you look at the last few years since COVID, forecasting has been very, very difficult for central banks. In 2022, for example, if you look at the year ahead forecasts by the Bank of England and also by the ECB, they were off on their year ahead CPI forecast by 7 to 10 percentage points in 2022. And
you're right. I mean, last year we had it all, right? Fed expectations, even in terms of economy, was like we'd have a hard landing, soft landing, then it was a curve landing. I mean, we've had all scenarios. Why is it so difficult? And also, why is it so difficult to predict the monetary policy tightening of last year, how that feeds into future expectations?
I think it's very difficult because it's always hard to know when the regime has changed. You're always the last to know when a regime has changed. And I think even if you go back to, let's say, the mid-2000s, when the Fed was tightening rates at every single FOMC meeting between 2004 and 2006, Greenspan was talking about the conundrum. He couldn't quite understand why long rates actually rallied about 100 basis points in the first year of this tightening. So that was a major regime change when globalization and demographics became a real factor over the last 20 years. Now, I'm pretty confident that we're in a new regime. And I think the conventional correlations of econometric models are no longer applicable. Right? Those correlations have changed, and how inflation is actually formed, I don't think anyone really knows. I think we're struggling to understand inflation, and whether it's the economics community or the policy community. I mean, this is a debate that has been going on since the creation of money.
But Richard, so we also struggle to understand where R star, the neutral rate, is, right? I mean, people say, well, it's a little bit higher. I mean, can we put a figure on that? Does it matter?
Well, I think R star, or the long run neutral rate, is actually a huge exercise in false precision. I think the neutral rate and R star, the amount of time that academics spend on this concept is really futile because it's a backwards looking metric, right? It's similar to concepts like the Phillips curve, right? The Phillips curve we've been talking about for 70 years since its creation, but is there any future predictability in the Phillips curve or R star? It's all backwards looking, right? It's like talking about price earnings ratios.
So what do you look at?
So what we try to do is we try to decompose economic variables and try to understand how those correlations may be changing for the future. So if you believe that we're in a period now of deglobalization, and what does that mean? And how the demographics that were causing deflation in the last 20 years are actually shifting now. And we're starting to see those same exact demographics turn to dissaving as the baby boomers start to actually finally retire and spend their money, or at least pass the money down to a younger generation, which has more of a propensity to spend. That has huge implications for how inflation is formed.
But so I mean, if you just take deglobalization, right, and if you assume that this fragmentation that we've seen continues, that actually there's, that trade gets redrawn because of geopolitics, that's inflationary. Well, you're also saying consumption, that's inflationary. So is there a risk that central banks can't cut?
Oh, absolutely. Absolutely.
Even the Fed? Do you think the Fed can actually raise at the next time?
Well, I do. I think that just 4 or 5 months ago, the markets were pricing in about 7 interest rate cuts for 2024, right? What's the reality? 0. And we think that it's unlikely that the Fed will be able to cut this year. And remember, we have a very significant presidential election coming up, and that does have policy implications. So I think once we get through all of this, it's pretty much a 50-50 bet whether it's going to be an ease or a hike at the next week.
What do you mean by policy implications? So actually what, depending on, because some of the policies are even more inflationary with the Republican administration?
Yeah, I think that actually with either administration, the policies will likely be inflationary. But I think if it is a new Trump administration, the likelihood of more fiscal and more pro-growth policies are going to be very, very likely pushing up inflation more. And obviously, tariffs. We don't know what's going to happen with tariff policy, but tariffs will be highly inflationary. So it's very hard for a central bank to really start to price that in to their forward policy reaction.
Richard, if you think 50-50 they could hike, or actually they could lower interest rates, the Fed, how do you play the markets right now? Because that's a huge, I mean, that changes everything.
Right, well, it's very tricky. So I think we're at a natural stopping point right now, or a resting point in the market, where we're pricing in about 2 cuts for the rest of this year. But I think that's more of a mean probability. If you think about the reality, the market's probably pricing in about 1 cut, and then pricing in some insurance that there might be an economic accident or a stock market accident. And that's the way markets have priced in sort of what we call the left tail risk for the last 2 decades. But I think it's really going to be dependent on data. It's going to be dependent on this presidential election. And I think you really have to be quite nimble in how you position yourself, but you also have to take everything from a bird's eye view. I think the market can get very micro-focused in the moment, and that narrative can shift very, very abruptly. And I think for the equity markets, the same thing. We've come a long way. I think that there's been a real secular movement of an underinvestment in the equity market since 2022 to everyone trying to get neutral again, and that's caused this rally. But now I think, as interest rate policy becomes more and more uncertain, and obviously the geopolitical situation and the political situation becomes more uncertain, I think you just have to be much more nimble about how you view markets right now.
Richard, thanks so much for joining us. Great to have you, of course, on the Pulse. Richard Tang, Global Head of Markets at Rokos Capital. Now, coming up, we'll have plenty more from Paris. Europe is in focus. We'll be speaking to the former MEP and former Deputy Governor of the Banque de France, Sylvie Goulard. That conversation is up next, and this is Bloomberg. Welcome back, everyone. Now, it's just 3 weeks until hundreds of millions of citizens across 27 nations head to the polls to elect a new European Parliament. Now, my next guest was Deputy Governor of Banque de France, also formerly a member of the European Parliament for West France, and briefly served as the nation's Armed Forces Minister. Sylvie Goulard, welcome to Bloomberg. I'm really delighted to speak to you because we were all watching news of this attempted assassination for the Prime Minister of Slovakia, something that Europe had not witnessed in over 2 decades. As a European, just as someone who believes in democracy and speaking amongst political markets, what does this tell us about the future of Europe?
Now, first of all, it's always very sad, and I hope that the Prime Minister will recover. Second, I think we should all take a minute and think on where we are. We have a tendency to take Europe, the stability, the democracy, the rule of law for granted. It may not be the case. So this is what is at stake in the next European elections.
Are people desensitized to thoughts that held us together in the past? Do you see an electorate that wants something more? When people go and vote in Europe, do they vote for the carton of milk or do they vote for something else?
Well, what I fear, and it's deeply sad, is that we have separate national debates on Europe where national governments or opposition parties very often try to nationalize the topics. They talk about parochial issues, they talk against the government. Some parties try just to catch the anger. This is not what is at stake. What is at stake is the European election. It is a European-wide, and it is the election. It's the only part of the world where we vote in a transnational government. It is about the rules, the laws, saving democracy, answering to Putin and Russia. This is what is at stake. Don't let you be abused by people who want to make it national.
But you were Deputy Governor, of course, of Banque de France. Does it boil down to inflation at the end of the day in that booth? Are people just going to look at how economically they feel compared to last time they voted and vote on that basis?
Well, the reason why the treaties are very clear that we should fight against inflation is that inflation creates instability in the economy and politically. We see it in the US as well. It is not only in Europe. But I would quite say that, unfortunately, the debate is not on economics. It's about very phantasmagoric visions of identity, migration, and fear. Many people are making campaign on fear and hate. And this is the reason why all moderates should really mobilize themselves.
When did that start? And again, is it, you know, do we go to history and say, look, this is the template of what happened in the future? Was the movement started in a particular region, and how do you see it evolving in the next 2 years?
History in the sense that the generations who knew what Europe really was are leaving us. They are dying now. They are leaving the stage, and the young politicians are sometimes completely irresponsible. You can disagree with some rules, but to put into question the framework could have catastrophic consequences. The second reason is the social networks and the way algorithm puts people in bubbles. And the third one is, of course, that we had a migration wave and that all our societies are very schizophrenic. We need workforce. We perfectly know that without foreigners, we will not have restaurants, hospitals, works in our streets. And at the same time, some politicians try to put the blame on people coming from foreign countries.
I mean, you know, sources are telling us that the French president is trying also to have a change of president at the European Commission. do people in France and elsewhere feel they're close enough to Europe? Again, Europe seems a little bit like the sick man in the world. You have China, you have the US firing in all cylinders, you have these fights, and Europe stuck a little bit in the middle.
Well, at the Bocconi University, we made a study with the Bertelsmann Stiftung showing that Ursula von der Leyen is much more known than any of her predecessors by the public at large. Second, I would say that we need to stick to the treaties. The treaties say that the European Council takes the candidate, the president of the Commission, in the family that arrives first in the elections. So there is a link between the election and the choice. As far as I know, Ursula von der Leyen is the candidate of the EPP. We will see, of course, what the result of the elections is. At this stage, I don't want to speculate. The key question is not only if one party is first. The key question is not to give the keys of Europe to the cuckoos, you know, these birds who want to put their eggs in the European Parliament without at all having any project, any sensible vision of the future.
But if people vote for them in mass, it means that there's something wrong with the system right now, that people feel unhappy. That's what democracy is about.
Yeah, but I'm not sure that they vote against Europe. I'm not sure. Some polls show that they would like more cooperation in defense, that they would like more security. The truth is that we have the wrong system to vote because we delegate to the member states at the national level the whole campaign and the way we choose. We don't have pan-European lists. When I was at the European Parliament, I was in favor of mixing the people in the list and Europeanizing the debate.
But this is, I mean, the rise of populism is something that's also at the sovereign level. So there's something wrong in the European dream and the American dream. Is that fair?
It is democracy. It is the case in UK. We had Brexit. It was the result of anger. In the US, they had Trump. That was the result of anger. And in Europe. And we should listen carefully to what people are saying. For example, they want a fair transition. They are not against measures for climate change. They are against the fact that there is not enough fairness. And they express anger against Macron or against Meloni or against Scholz. It does not mean that Europe is always the problem.
Sylvie Goulard, thank you so much for joining us. That was the former MEP and former Deputy Governor of the Banque de France. We'll have plenty more, of course, from the JPMorgan conference throughout the day. This is Bloomberg. Well, Slovakia's Prime Minister Robert Fico is in serious but stable condition after an assassination attempt on Wednesday. Now, the country's interior minister says the shooting was politically motivated. For more on this, we're joined by Rosalind Matheson, Bloomberg's EMEA news director. Ross, frankly, this was shocking, and it was shocking for everyone in Europe. We haven't seen anything like this in at least 2 decades on European soil. Will it have an implication on European elections?
Well, it's interesting, the timing, obviously, because it comes shortly after the presidential election in Slovakia, and as Slovakia has become deeply polarised under the administration of Prime Minister Fico, very pro-Russia, anti-the war in Ukraine, anti-EU, anti-NATO, anti-NGOs, anti-LGBTQ rights. And so there's real division that we're seeing in Slovakian society, but it's not Slovakia alone. As you say, we're coming up to the EU elections. The mood in Europe just feels very uneasy, very tense. I mean, there's the impact, obviously, again, of Russia's invasion of Ukraine. What does that mean for the rest of Europe with Putin on their doorstep? You know, what are his longer-term intentions for Europe? What to do about Ukraine? But then you've also got the issues around the European economy. You've got issues around immigration that will feed into the EU election. You've got some governments with their liberal administrations pushing against, the independence of the courts, of the media, against LGBTQ rights. And all these things are becoming quite tense issues across Europe as a whole, in Eastern Europe certainly, but also even in countries like France and Germany. And so you've got parties on the far right, parties on the far left, a lot of people confused and divided in the middle. And really, you're seeing parties play off those divisions. And we're seeing a lot of disinformation flowing as a result, and possibly the hand of Russia and others in all of that. So it's just a really tense environment. And obviously, this shooting comes at a difficult time for Slovakia, but also those bigger questions for Europe as a whole.
Ross, very quickly, I mean, we always thought that this possible alliance between Russia and China was almost a marriage of convenience. But actually, we heard from President Xi that he wants this, I guess, sympathy to last for generations. What do you make of that?
Well, it's certainly seen by both sides as a long-term relationship that benefits both of them. I mean, it does ebb and flow a bit in terms of importance for each of them, but overall it's seen as, a buffer together against, the US, for example, against the West as a whole. So they're supporting each other economically, but also strategically, and it makes sense for both of them. And you can see from the language from this visit at the moment, from the Russian president to China, it suits them to do so.
Yeah. Ross, thanks so much as always. Rosalind Matheson, Bloomberg's EMEA News Director. Coming up, we go back to the markets and talk FX. This is Bloomberg. Global stocks rally with the S&P 500 hitting another record high as cooler U.S. inflation reinforces bets on Fed rate cuts. Now, Slovakia's Prime Minister is in a serious condition after being shot in an assassination attempt, the first on a European leader in more than 2 decades. Plus, Xi Jinping tells Vladimir Putin that China-Russia ties should last generations as a Russian leader receives the red carpet treatment in Beijing. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris at the JPMorgan Global Markets Conference. Now, signs of easing U.S. inflation boosted bets that the Fed will ease policy this year, causing the dollar to weaken broadly against its peers. Now, the yen was one of the biggest gaining currencies, though it's paired some of those moves since. Now, the yen moving further away from the zone that prompted suspected intervention in recent weeks. Joining us now is Mira Chandan, Global Co-Head of FX Strategy at JPMorgan. Mira, as always, thanks so much for joining us. I mean, you certainly had some pretty exciting moments. It has not been dull in FX. I think we can start there.
Definitely, yeah.
But in fact, a bit of a roller coaster. Like, what happens to dollar now?
I think, look, I mean, there's a medium-term issue, which is that the dollar should stay well supported because at the end of the day, even with the inflation outcome that we had, the Fed is still only going to be cutting twice, at best thrice this year. So if the dollar is still at close to 5% yields, that's still pretty attractive for the currency. But I think in the near term, there is certainly a pocket of weakness that's well within scope because I think the inflation number came as a bit of a relief. I don't think it changes the game narrative for the Fed, but
it doesn't. But the markets were ran with it.
And I think the issue we've had and the concern we've had around bullish dollar view has basically been that investors have actually been quite long the dollar. So I mean, unlike in U.S. rates where positioning hasn't been that crowded, actually positioning in dollar length was quite crowded. So I am concerned near term that we see a bit of a fallout here. But I think come the June meeting, I think there's still a decent chance that the Fed could because they still haven't internalized this last 3 months of inflation data. It's going to be to the upside, but I think there is a bit of a pocket of weakness here in the dollar.
But I guess, dollar strength was a problem for many countries, right? And it was the first time, certainly, that I remember the Treasury Secretary kind of acknowledging, I don't know if she was giving the blessing for intervention from certain emerging, economies, but she certainly maybe wasn't as robust in the past in trying to push back against it.
Well, I think the U.S. and also they issued that joint statement with Japan and Korea a few weeks ago, and I think it's all a part of, the strong dollar is not really a U.S. problem. It's a problem for the Asian currencies, and I think it was a green light for them to say, okay, you can intervene if you want, and I think the Ministry of Finance in Japan certainly did that. The Asian currencies have been doing it. Central banks have been doing it in any case, but this does take the pressure off of them. I mean, if U.S. yields are lower and and the pressure is off the Fed, equally it's off Asian central banks. So hopefully they'll have less of a need to do it. Dollar yen in the mid 150s, though. I mean, if the Fed is still at 5% at the end of the year, I think we would be testing 160 again in dollar yen for sure, because BOJ is just way too dovish compared to the Fed.
I mean, how much more can they intervene? And again, it's interesting that they were kind of very tentative in just coming out to the markets and saying, guys, that was one of our operations.
Yeah, they did $55 billion already in that first week, and I think I think they know that at the end of the day, the reason why this yen weakening is happening is because of fundamentals. It's because the BOJ policy is way too easy compared to the Fed. And if they don't fix that, they can't really fix the yen weakness. So I don't think intervention is the solution here. So they can throw a bit more money at the problem. This is not going to change the narrative. It's going to come down to, will the BOJ have the ability to raise rates? Which I think is harder because it is an indebted nation. You know, the government's highly indebted, and they're just used to low rates. So they don't want to rush into hiking rates too quickly. Otherwise, you know, something might break.
But do they just need to go at some point? I mean, inflation again for them is in the right direction.
Well, inflation has been in the right direction. They've just not moved, and the market's latched onto that because. Even, you know, you might say your policy is unchanged, but actually if inflation's gotten higher, your real yields become more negative and you haven't really caught up to that reality. But I think they're going to hike a couple more times this year. You know, we think a total of 50 basis points in the second half. But if the Fed's at 5, it's not going to make a difference. So I do think that the market's going to be testing them on dollar yen higher once again.
Samir, in terms of pairing for the yen, I mean, do you go dollar yen or euro yen? Because that's also quite an interesting play, right?
Yeah, definitely. I mean, dollar yen, I think, is certainly the more divergent view because unlike the Fed, the ECB is actually going to start cutting in June. But even with euro, you know, I think what we have to keep in mind is European growth is now improving. It's a very different situation if the ECB is cutting because we're heading into a recession in the Eurozone, but that's not the case. They're actually cutting despite decent growth because inflation is coming off, and I think that's actually euro can be in certain instances euro positive, certainly should be euro positive versus yen. So to me, it would be actually a higher conviction move to say dollar yen probably higher because the Fed's actually inactive. So dollar yen is more relevant than euro yen.
I mean, we're quite in a quirky year, right, where the ECB and the BOE move before the Fed.
It doesn't happen. It hasn't happened. It's the first time since the inception of the Eurozone in '99 that the ECB is going to be cutting before the Fed. And in fact, I would go on to say that by June, 45% of global central banks would have already cut before the Fed. And again, if you go back last few cutting cycles, that doesn't happen again. So in fact, emerging markets is leading the way higher compared to the Fed, lower compared to the Fed, and actually ECB, very unusual for the ECB to be doing that, but that's what's happening.
But so what does it tell us? I mean, again, this is a cycle like we've never seen before, right? Yeah. So we don't really have a textbook on this.
Yeah, you know, it tells us, I think, that that the Fed cut by itself is not going to be enough to get you that massive dollar weakness, right? Because the Fed's not the only game in town. In fact, as far as the cutting cycle goes, they're probably one of the last games in town. So it just means the dollar maintains its yield advantage, and I think it would be a mistake to look at the Fed easing and say, oh, this is enough to get us dollar weakness, because actually, if half of central banks have already cut before, it's not going to matter. So I think this means that despite a cutting cycle from the US, actually the dollar can stay pretty strong in that environment.
How do you look at renminbi? I don't know whether it's kind of in the focus, but we're still trying to figure out exactly what happens to China in terms of what kind of package they can do to support the economy and how much they contribute to the rest of the world. Is this a good? Is it a good story for you?
Well, again, I think everything's coming together because you've got a soft U.S., softer or not as high an inflation print in the U.S. You've got European growth improving, and you've got now China stability measures coming into play. I think it remains to be seen to what extent this is going to be having an impact on the currency. But I would say that it's not going to be as commodity intensive. Any support package is not going to be as commodity intensive as it has been in the past. So just because there's some additional support pressures doesn't automatically make it good for commodity currencies, and it doesn't automatically make it dollar negative. So I think it's yet another signal of hope for global growth, but this is going to be a long drawn-out problem. It's not.
If we see retaliation from China on some of the tariffs that the U.S. put, does it automatically benefit some of the neighboring countries as the trade routes are redrawn, or again, does that take time and a lot of it have already been done?
Well, the Biden tariffs are pretty limited in scope. It's a small number compared to the entire trade surplus that China has with the US. If that expands out, that could be more meaningful, but it is a growth hit to China. If all else equals, it is a growth hit, which usually equates to weaker currency. So I think, and then obviously, as we know, Asia has been under pressure in general in any case because of what's going on in Japan and what's going on with US yields. So I think it actually puts more pressure on Asian currencies. Any trade conflict will make the Asian currencies more vulnerable. And I think that's the angle that I would focus on rather than this being a boost for commodities, because I don't think that translates.
Mira, thanks so much, as always, for joining us. Mira Chandan, their global co-head of FX strategy at JPMorgan. Now, a reminder that at 1:15 p.m. London time, 2:15 Paris, we'll also be speaking to the JPMorgan Chief Executive, Jamie Dimon. So don't miss that interview. Coming up, our exclusive conversation with the Chairman of the European Banking Authority. He's Manuel Campa. We'll discuss commercial real estate, private equity, and maybe, just maybe, we'll talk about consolidation of European banks. That's next, and this is Bloomberg.
The biggest problem is that racism and extremism is really having a huge impact in the long run on our democratic systems. It creates a system of fear. They give simple answers to complicated questions. They never work. So, at the same time, this is the biggest fear, that we need immigration. We need to have an open culture of integrating different cultures and diversity.
Now, that was a Siemens chief executive, Roland Busch, on his calls for more immigration and tolerance in Germany. Now, that full interview available on the Bloomberg terminal and on our website, where he also discusses why China's weakness is weighing on the German manufacturer. Now, let's talk about some of the concerns, and let's stick with Germany. The country's banks have seen a jump in customers struggling to pay back commercial property loans in the fourth quarter. Now, the sector is still adjusting to higher interest rates and changes in consumer behavior after the pandemic. Well, let's discuss all of this with the chairman of the European Banking Authority. He's Manuel Campa. He joins us exclusively from Paris. Mr. Campa, thank you so much for joining us. I mean, as far as I can remember, which is 12 months, we've talked about commercial real estate as needing to adjust to these environment of higher interest rates, about something going wrong, about this being unsettled. Is it going to take longer for all of this to shake out?
Well, I think, as you said, we've been talking about it already for almost a year, but I think we're likely to talk about it more over the long term, because at the end it's really a structural change that's taking place. You know, after COVID, we know that people are engaging in working activities in a very different manner, and that affects commercial real estate activities across the board. Commercial real estate is very broad in content. It includes many different things, but I think it's an adjustment that's taking place over time, probably affecting more some of the pure home office buildings in city centers that are very financially or office oriented. But we will see that evolving over time. You know, we monitor that carefully.
When you say over time, I mean, do you see a point where there's just distress because this catches up and they have to refinance and reload? Or do you think this is being managed as some of the big companies, for example, sell off their portfolios and refinance gradually?
I think it's being managed, but I think at the same time, when we look at the type of loans that many commercial real estate firms, they tend to be what we call bullet loans, which is when all the principal gets repaid at the end of the life of the loan. So that basically requires either an ability to refinance or a lot of cash at that point to be able to pay back that loan. And that's a situation that needs to be managed carefully, you know, so that may lead to some situations of potential distress. As we look overall, the banking sector, you know, the overall exposure of European banks to commercial real estate is not that large. It's in the range of 10% of their loan book. But that's, of course, is an average across the region.
Is there anything that you worry about banks right now? I know, you know, in the past it's been concerns about liquidity. I don't know whether there's quite a lot of market volatility, although markets seem to be, you know, behind some encouraging news of late because of the Fed. But what worries you the most about the sector right now?
Well, as you say, you know, how the interest rate environment is going to evolve and develop over time, it's always a source of concern, you know. And so far, the central banks have been able to keep interest rates up without really damaging either the financial sector or the real side of the economy. And employment's performing very well in the major economies, so that's all good news for credit quality and for banks' overall assessment of credit risk. So in that sense, so far so good. As we go forward, I think that beyond the interest rates, there's the whole macroeconomic uncertainty on geopolitical terms. I think that's a big source of concern for us. That has different ramifications. Within those, I would like to highlight two. One is potential cyber risk, cyber attacks, cyber tensions. That's an area of vulnerability. Second one, potential fragmentation, more structural over the long term.
Mr. Campa, I mean, there's also, I'm sure you've been kept busy by some consolidation efforts, first of all, domestically, Sabadell and BBVA. Do you think there will be that kind of consolidation? Is it healthy? Is it important to have it? And does it have to be non-hostile for the cross-border consolidation to arrive?
Well, we've been very keen for many years on the idea that we think that consolidation in Europe will be a good strategy of the banks. But at the same time, I always said that the goal is not consolidation per se. The goal is to put forward on the consolidated a stronger business case and business model than of the entities that were working before in a separate manner. So that's very important. What's the underlying business structure? As a European authority responsible for deepening the single market in Europe, I'm very keen on fostering cross-border consolidation in Europe. That has not happened so far. So I hope the economics, now that the interest rate environment is more healthy, that the economics will work for the banks to push on that consolidation. As I said, that is what I like to say, constructive destruction, so that the good ones are able to increase their market share, increase their activity, the well-managed banks, the not so well-managed banks, they're orderly leaving the market.
But why haven't we had any so far? I know that a lot of say, well, the regulators have been pushing back. Our editor-in-chief spoke to President Macron on Monday, and he was also open to this idea that a French bank could be taken over. I mean, when it comes to seeing it on paper, is that really true?
Well, I was actually, to be honest, very, very, very happy to hear the remarks by President Macron. I think those go in the right direction. That what matters is the single market at the European level. We need to think more of European interests in an effective market rather than individual national interest, because we have seen consolidation over the last decade, but has been mainly happening at the local markets within national boundaries in the European Union. So what will be good is having cross-border. Now, the economics for cross-border consolidation, the banks, when I talk to banks executives, they see more challenges. They see more challenges because they think it's different. It's more difficult when you think about the gains from that consolidation arising from cost reductions. There's less overlapping of branch networks. That's more difficult to consolidate. Also, back office of operations, some of the headquarters within, if they're across different countries. All that are issues that we need to try to address.
But is Spain overbanked? To you, does it make sense, BBVA Sabadell?
Well, I don't know. That's for them to decide whether it makes sense or not. I think that overall, there's evidence that there's a lot of banks in Europe, over 4,500. Spain particularly, actually, it's been already a fair amount of consolidation. So at the national level, is one of the countries that has the highest level of concentration of banking activity. But when I think about wider in Europe, I think consolidation is good. One thing that I like a lot about the consolidation that has taken place in Spain is that it has been a consolidation that has created stronger banks overall. So the way I like to say, the good ones won. And that's something that you like to see.
Talk to me a little bit about consumer loans. I mean, again, there's this idea that actually we're okay, that consumers are okay. Do you see any stress in some of the figures that banks are showing up? Or is there a danger that it's not the banks that sees something bad happening first?
Well, exactly. On consumer loan, what happens first, the prevalence of consumer lending in Europe relative to other economies is much lower. It's much lower. Having said that, there's been always an area of vulnerability on consumer loans, which tend to be the lower income, more vulnerable individuals that maybe they don't have access to a type of loan, and they get credit card loans or auto loans in a very demanding terms, and as the interest rates rise up, they put pressure on them, and they're by definition the most vulnerable. So that's an area of concern. I would not say that that's a concern for financial stability or a concern for the solvency overall of the banking sector, but it's a concern for certain groups that are vulnerable in society.
So good to speak to you. Thank you so much for joining us. That was Jose Manuel Campa, the chairman of the European Banking Authority. Now, we'll have plenty more, of course, throughout the day on some of the markets that we're seeing also coming up. Roaring Kitty goes quiet. Yes, so this is a meme stock rally. It's been fizzling with Gamestop shares taking a tumble. So we'll talk about meme stocks next. This is Bloomberg. Welcome back, everyone. Now you're watching live pictures from day 3 of the Qatar Economic Forum in Doha. Bloomberg's Romana Berkshire hosting a panel called Venturing into Disruption about how venture capital is raised. Now, speakers include the founders of companies like Alphawave, WonderCo, Golden Gate Ventures, and Global Ventures. Now, take a listen.
Because you're starting with them from very early on.
Well, I don't think there's a right or a wrong. These are, just. I think different expertise that you develop. I think what's particularly exciting for the WonderCo team is finding those great entrepreneurs with great ideas early enough to really be able to bring value to them. I know everybody talks about that. Starting a company 0 to 1, I like to think, is impossible, and 1 to 10 is improbable. And so getting on the journey, with young entrepreneurs and companies that have already achieved that 0 to 1, and where,
well, of course, you can follow that. Our coverage continues on T-Live on your Bloomberg terminal. Now, the meme stock rally, of course, has faltered with a chunk of the $11 billion in gains made by Gamestop and AMC Entertainment wiped out yesterday. Now, the stocks more than doubled after the return of social media posts by Keith Gill, better known as Roaring Kitty. What a name. Now let's get more from Bloomberg's Charlie Wells. So, Charlie, good morning. What drove and is now sputtering this rally?
Francine, I think it comes down to a pretty simple thing, and it's that Wall Street has wised up to Wall Street bets. So professional traders now know when to get into these meme names like AMC, like GameStop, but they also know when to get out. And I think that's changed significantly, especially from 2021 when we were in the thick of that meme rally. I covered that, and it was incredibly exciting. But I think what is different, of course, is the economic situation that we're in right now, too. And I think that's why this was somewhat surprising, that interest rates are a lot higher, but you're still seeing this kind of activity. And so, something else that's different is there seemed to be some short interest, but less short interest than in 2021. And that looks like it's not going to keep this rally going, as long as some people may have expected.
So, Charlie, is there a consumer read-through that we get from this week's meme boomlet?
Well, this is in a lot of ways why we care about meme stocks, because, at least in some parts, they reflect the retail trader. They reflect the retail trader who is a consumer. And I think there's an interesting story here about a consumer who feels comfortable making some of these speculative plays at a time when overall consumer sentiment has been pretty negative. And so I think there's a story you could tell that, maybe that behavior is better than what consumers have been saying. But I think that really kind of hinges on how much of this activity was the retail trader and how much of it was that wised up Wall Street professional.
So, Charlie, really quickly, shifting from small-scale traders to big players, major investors have been revealing their holdings in 13F filings. What have we learned?
Yeah, best thing to come out of this was we finally got an answer to what Berkshire Hathaway has been doing. They've been allowed to keep some of their holdings anonymous from the SEC. That is allowed. But what we found out in these 13F filings is that Berkshire Hathaway has taken a $6.7 billion stake in Chubb. That is one of the largest insurers in the United States. They also operate in 54 countries. No surprise that Berkshire Hathaway interested in insurance.
Charlie, thanks so much. Charlie Wells there with the very latest. Now, another reminder, we have Jamie Dimon, 1:15 p.m. London time. This is Bloomberg.